focus on merchandising operations now. Accounting for merchandising transactions, controlling cash, creating a bank reconciliation, so as it relates to internal control over the merchandising aspect of accounting, maintaining control can be difficult for a merchandiser because management must not only establish controls for cash sales, receipts, purchases, and cash payments, but management also has to come up with ways of protecting the inventory. So they've got to safeguard the whole cash accounting process and also the inventory aspect. Most firms use the following procedures. They have separate functions of someone who authorizes versus someone who keeps the records versus someone who actually has the physical responsibility of the cash. So if authorization, the individual who authorizes the transactions, is separate from the person who keeps the records of the transactions versus someone separate of safeguarding the cash, usually you've got pretty good controls in place. Limit the number of people who have access to cash and designate who those people are. So the fewer people that actually can touch cash are going to give you a little more controls over the cash. Of course, bond employees. Physically protect cash on hand by using cash registers, cashier's cages, and safes. Record and deposit all cash receipts promptly. Make payments by check rather than by currency, so you have a footprint of what's going on. Have a person who does not handle or record cash make unannounced audits of the cash on hand. And have the person who doesn't authorize, handle, or record cash transactions reconcile the cash account each month. So you see that separation of duties needs to be in place. When cash gets sent in the mail for paying the receiving invoices, cash payments for sale of goods or services can be received by mail or over the counter in the form of checks, credit or debit cards, or currency. But whatever the source of the cash, it should be recorded immediately in a cash receipts journal. Don't let it sit around. One person should automatically record that so a written transaction is made instantly. When cash is received in the mail, the employee who opens the mail should make a list in triplicate, 3 parts, of the money received, 1 copy to keep, 1 to go with the cash to the cashier, and the 3rd to go to the accounting department for recording. Why? Because that way, that cash that's being opened, one aspect of it goes to the person who needs to make that deposit, but doing it in triplicate, then, because accounting now gets a record keeping of it, there's a safeguarding of the assets because 3 people instantly know about that one transaction. Cash registers and pre-numbered sales tickets are common tools for controlling cash received over the counter. Why? Because pre-numbered sales tickets, you'll know if something's missing. So if you have sales tickets that are all pre-numbered, what happens if one gets voided or one's missing? You're going to question what happened there. The amount of each cash sale is rung up on the cash register, which should have a locked-in tape on which it prints the day's transactions. At the end of the day, the cashier counts the cash in the register and turns it in to the cashier's office. The amount of cash turned in and the amount recorded on the tape that's locked should agree. If it doesn't agree, they got to figure out why, the discrepancy. To avoid theft, cash payments should be made only after they've been specifically authorized and supported by documents that establish validity and amounts of the claim. Do you see over and over again? You need people to create this separation of duties, don't you? It's harder when you have a small company doing several things. A company should also separate the duties involved in purchasing goods and services and the duties involved in paying for them. So, as you see here, here's an example of the banking system. So you start here with number 1, a purchase requisition. So a department that needs an item for purchase requests it, sends it a requisition to the purchasing department. Okay? The purchasing department then goes and creates a purchase order copy that goes to the accounting department, but the original purchase order goes to the vendor requesting the item. Okay? Once the vendor ships the goods, those goods are going to go to the receiving department or to the warehouse. And when those goods come in the warehouse has someone on hand that counts what's being received. The receiving report gets sent to the accounting department. The vendor, when they ship the goods, then creates an invoice and sends it over to the accounting department. Okay? Now, the accounting department's going to match up the invoice with the purchase order and the receiving report to make sure what they ordered is in fact what we received and what we got billed for. Do you see how all of this is coming together in the accounting department? Once they can approve that in fact what was requested, shipped, received, and billed for all matches up, then the accounting department is going to, with all the documentation, request a check to be mailed to pay the vendor. See what I'm doing here? Then the vendor ultimately is going to take that check, put it in their bank, and their bank ultimately is going to come back to our bank to show that the check was cashed and will flow back through the bank statement back again to the accounting department. Does that make sense? Do you see how there are internal controls in place to know that items that are requested get the appropriate approval and go to a department that specifically is focused on making purchases? Oftentimes, one of the controls is set up in place where the purchasing department has authorized vendors in place. You know what I'm saying? To make those, they only purchase items from authorized vendors. Once the purchasing department creates the order, then this various flow of paperwork and, again, needing someone in the receiving department that takes the time to accurately check that what was received is in fact what was ordered. See how all this takes responsible people to make sure that in fact what was ordered is what really got received, what got shipped, what's getting paid, billed for. You need responsible employees in order for this to work appropriately. Even honest mistakes. The guy's had a late night. He just fought with his wife. He tries to do the counting, but just got a little off, showed everything came in when in fact it didn't. So an error can just happen with the goods just coming into the warehouse because they counted them wrong. So this is a good form of internal controls, but you need a large company in order to do this. When you only have 2 people in your accounting department, it makes it kind of tough to segregate duties. Internal control plan for purchases and cash disbursements. So basically you see here a purchase requisition happened, got sent to the purchasing department. From there, the purchasing department creates a purchase order. One goes to the vendor, one goes to the accounting department, and then from there, once that order gets shipped, we have a receiving report, which ultimately flows back to the accounting department. The inventory, the receiving report, and the purchase requisition all need to match up in order for a check to be written and the bill to finally go through that process. So basically, purchasing a purchase requisition is really created by the department that needs the goods. That gets sent to the purchasing department. From there, the purchasing department creates a purchase order that gets sent to the vendor. From there, an invoice is created by the vendor that gets sent to the accounting department. From there, a receiving report is created by the receiving department or the warehouse that gets sent to the accounting department. From there, the accounting department takes the invoice, the purchase order, and the receiving report. Accounting verifies the prices, and from there then, the accounting department takes this information, compares it, and creates a check authorization supporting those documents. That gets created by the accounting department, sent to the treasurer. From there, the treasurer creates the check. The treasurer examines all the documents, approves them, or assigns them with an electronic check, and that check gets sent to the vendor. Then, from there, the vendor deposits that check in its bank, and the canceled check ultimately flows back to the bank statement of the company. So it gets received by the buyer's bank. It ultimately then ends up back in the accounting department when somebody in the accounting department reconciles the bank statement. The accounting department compares the amount and payee's name on the return check with the check authorization. Does that make sense, the flow? Now, cash, a lot of paperwork. One order. It's a lot of paperwork. Management can put money into cash. Oftentimes, they will use forms of other means that can create some better interest on their money, such as certificates of deposit or treasury notes. If these investments have a term of 90 days or less, then they're called cash equivalents. It's similar to cash because the funds can revert to cash quickly. There are other ways in which companies can utilize methods of protecting cash. I'm not going to worry about that right now because we're going to deal with it in way other courses. But I have a lot of clients that they don't even receive checks at the office. They go directly straight to the bank. So when an invoice gets sent out to a client, the return address is right to the bank. So nobody can even alter or play with the money. Bank reconciliations is really what we're going to cover here. the process of accounting for the difference between the balance on a company's bank statement and the balance in its cash account. So, some of the aspects when we're dealing with reconciling a bank account, there are outstanding checks. In other words, checks a company has written and sent off, but maybe have not cleared the bank statement yet. There are deposits in transit. Deposits a company has sent to the bank, but the bank hasn't yet recorded them or entered them. Transactions that could appear on the bank statement but not in the company's records may be various charges that a bank charges the company, such as return check fees, service fees, that the bank has recorded but the company has not yet recorded. Interest income. Oftentimes the bank will account for any interest received on the savings and checking accounts before the company knows what that amount is. So we're going to look at a bank reconciliation and understand how we take the figures and link them together, how we reconcile the bank balance with what we call our book balance. So as you see here, Kalidas Services Bank Reconciliation, the bank statement shows a balance of $1,735.53, and the company's records show a balance of $1,207.95. The bank reconciliation adjusts both the bank and the book amounts to a new figure, $1,277.94, and we'll see how. If you start with the balance for the bank, that's the first thing we're going to start with. And then from that balance for the bank, we add deposits in transit. So these will be deposits that we have in our books, but the bank hasn't received yet. So we add our deposits in transit. Then from the bank balance, we subtract any outstanding checks to come up with what we call an adjusted bank balance. If we then take our balance for the books, we add the items that the bank has credited on our behalf to our account, and then we subtract any service fees or any type of collection fees. Our then adjusted bank balance should equal our adjusted book balance. Does that make sense, guys? Let's do a problem like this. Okay, let's get in here. Let's find You need to turn on the light?
No, I can't see it. I can't use my glasses for my book. I need like readers, this is the old age thing.
I just got progressives, and oh gosh, it's so nice.
I was supposed to get them today, but I couldn't see on them.
I know.
It's like you have to go on the very top like this, or go
That's why I have my cheaters too. Well, this is okay because I'm looking down at this. But if I'm straight and I'm looking, then I have to do that, which is frustrating.
So I'm not used to that.
I know it's hard. Okay, guys. So let's look at an example.
What about if you look straight out?
Then it's easy. No, not at all. It's wonderful.
The top is supposed to be far distant.
But it's progressive, so it kind of, here I can see Tanya perfectly. As I get closer, I can see this better, and then as I get farther down, I see little better. It's so awesome. Do we need to turn on a light, guys? How are y'all doing? Okay, just checking. Okay, guys, so let's look at a problem, and let's go through a bank reconciliation so we see the entire process, okay? Problem P4. Can anyone tell me what page P4 is on?
On page 329.
Okay. So P4. The following information is available for Sedona, Inc. as of May 31st, 2014. Cash on the books as of May 31st amounted to $42,754.16. Cash on the bank statement for the same date was $52,351.46. Then it tells us a deposit of $5,220.94 representing cash receipts of May 31st did not appear on the bank statement. Then it tells us about outstanding checks that were on the books but not the bank, totaled $39,3680. It tells us a check for $19.20 returned with the statement was recorded incorrectly in the check register for $13.80. A check was for a cash purchase of merchandise. Then it tells us about a bank service charge. The bank collected money on a note, an NSF check. The bank mistakenly charged to a company account a check for $850 drawn by another company, and the bank reported it had credited the account for $120 in interest on the average balance for May. We need to prepare a bank reconciliation. So what we're going to do is create, and I'm going to go to Excel here. Okay, so I'm going to pull up and we're going to create this reconciliation similar to what we just saw on the slide. So the first thing I'm going to do is have a title to my statement that is going to say Sedona, Inc. Bank Reconciliation, May 31st, 2014. Now, the first item that I'm going to use involves the balance per the bank as of May 31st, 2014. So we know that based on the information provided to us that The cash on the bank statement for the same date was $52,351.46. Do you see that in P4A? So balance per bank is $52,351.46. Okay? What is the next thing we're going to want to do? Let's go and look at if you look at page 313, it allows you to see an example of the Kalita Services Bank reconciliation. Okay? So aren't we going to try to look at deposits that we show on our books but have not been deposited into the bank? Remember, we've got our bank balance, but we need to adjust that bank balance to items that the bank doesn't have yet, or that may be incorrect. So we see a deposit of $5,220.94 representing cash receipts of May 31st that did not appear on the bank statement. Isn't that an adjustment we're going to need to make? So we'll add deposits in transit. That is $5,220.94. What else may we see to adjust our bank statement to our books? We see outstanding checks totaled $3,936.80. Those are in our books but not our bank, right? So let's show here less outstanding checks of $3,936.80. Another thing, do you see number H? The bank mistakenly charged to the company a check for $850 drawn by another company. How they did that is beyond me, but the bank charged our account for money that shouldn't have been charged. Did this affect our books at all? No. Okay? We saw it when we were going through the bank statement, the bank reconciliation. We saw this in error. So it's not affecting our books because it was wrong. So we need to add back to this a check of another company mistakenly deducted by the bank of $850. So we need to add these two items together, right? And then we need to subtract from that the outstanding checks to get an adjusted bank balance of $54,485.60. Okay? Make that a little bigger for you guys. Can you see that okay? So guys, what we did here is we are trying to reconcile the bank with our books. The bank's balance doesn't include deposits that were in transit that haven't hit the bank yet, and it doesn't include outstanding checks that we show but haven't hit the bank yet. The other difference or discrepancy is the bank accidentally took money out of our account that was done in error. So we need to adjust our bank to show, hey, you did that wrong, add it back. Okay? Now the next thing we're going to do is look at the balance for the books. It tells us cash on the books as of May 31st amounted to $42,754.16. So I'm going to show balance per books, May 31st, 2014, $42,754.16. What do you think we're going to do next, guys? Let's look at some of these. A check for $1,920 returned with the statement was recorded incorrectly in the check register as $1,380. The check was for a cash purchase of merchandise. So we recorded it in our books as $1,380, but it should have been $1,920. What's the difference there? If we recorded it as $1,380, but it should have been $1,920, we're off $540, right? So we deducted less than what we really should have. We should have deducted $1,920. We only deducted $1,380. So in this case, we're going to have some additions, but this is going to be a subtraction. Check recorded incorrectly in the check register. $540 incorrectly. Okay? Let's look and see something else. The bank service charge for May amounted to $25. Now, the bank balance has that $25, but we don't have it in our books, do we? So, that's another thing we're going to subtract. First one was check recorded incorrectly. Now we have to deduct the bank service charge of $25. Does that make sense so far? Next, the bank collected $12,360 for Sedona on a note. The face value of the note was $12,000. Okay? So the bank collected for us $12,360. The face value was $12,000. We're going to show here an addition. We're going to show the bank has it. We now need to put it on our records. This is note receivable collected by the bank for $12,000. Then interest on that note, interest on note collected by the bank, $360, right? You guys get that so far? Yes? No? Okay. Do you see here, $12,360? The bank, we have a customer that owed us a lot of money. And they were having some problems, so we decided instead of having this as like an account payable, or account payable for the client and accounts receivable for us, we turned it into a note. We said, okay, you've got 5 months to pay us this money. So we have a note outstanding that we're charging interest on. It's set up with the bank that when this note came due, the customer was going to go and pay it directly to the bank. Okay? So, the bank received money on our behalf, $12,360 worth. $12,000 of it is a note sitting on our book, a note receivable sitting on our books. That's the principal amount we were expecting to receive. The extra, the $360, is interest we're getting as a result of holding someone, having a note for someone. Okay? We gave them an extended period of time to pay something, and as a result, charge interest for it. So we need to show that on our books, we didn't know we got that money. So to adjust the book balance and the bank balance, we are going to show the note receivable got collected from the bank of $12,000, and in addition, we also received interest on that note of $360. Now it says an NSF check for $183.56 from a customer was returned with the statement. So basically, we must have made a deposit, recorded Eva Mendez check, and it bounced. Okay? So we need to show that money. We got to subtract it back out of our account. NSF check of Eva Mendez of $183.56. Okay? Then, one more thing happened. The bank reported that it had credited the account for $120 in interest on the average balance for May. So that's money that increased our bank balance, but we don't show on our books yet. So we need to add that to our book balance, interest on the average balance of $120. So what we're going to do here is add we started with a balance per the books. We add those items that are in the bank that we received that we don't have in our books. And then we subtract the items that the bank has reduced from our account, but we don't have reduced in our books yet. Do you see how our new adjusted balances The adjusted bank balance is $54,485. And do you see our adjusted book balance is also the same amount, $54,485.60? Does that make sense? Now the next thing it wants us to do is record the journal entries based on these changes that we now need to create journal entries to show these transactions. Think about a transaction involves source documents that have changed and that have affected our economic condition. So the first thing I see is this note receivable collected by the bank. We need to show that we in fact did receive that note, didn't we? So the first transaction or the journal entry we would want to show is to show on May 31st, we now have a debit of cash of $12,360. And we now get to credit our notes receivable for $12,000. Why? Because we're not due that money anymore, are we? It came in. And we also then are going to credit interest income for $360 because we received interest. $360 of that money was income we earned. Does that make sense so far, guys? The next transaction, we need to record the $120 of interest we earned on our account. So, again, on May 31st, we're going to have a debit of cash of $120. We're going to have a credit of interest income for $120. Right? Now, do you remember up here, we incorrectly posted a check and it was off $540? So we need to adjust our books to show we in fact purchased $540 more of merchandise inventory than we initially recorded in our books. So we're going to debit merchandise inventory or purchases depending on what system we have of $540. And we're going to credit our cash of $540. And I'm just going to write this to correct an incorrect entry for purchase of merchandise. We originally had 1920 minus the 1380 equals the 540. What else are we going to do here, guys? Do we have a bank service charge? We have a bank service charge expense of $25. We can credit our cash of $25. Now we thought we got paid by Eva Mendez, but guess what? Her check bounced. So we're going to adjust that. We're going to now debit our accounts receivable again since her check did not clear. And we're going to credit our cash. Think about this. When we got her check in the mail and we were going to deposit it, we debited cash of $183.56 and credited our accounts receivable because she didn't owe us that money anymore. But now that we have the NSF, that's no longer right. Correct? So this is NSF check of Eva Mendez returned by the bank. How you guys doing? We can do another bank reconciliation, P9. You want to take a break or do you want to keep going?